I think this is like the first time they're doing this online quiz. So yeah. So I think they're still figuring this out. Just curious, because I'm not able to see your grades and all. Do you all get your results straight away after the quiz?
Yeah,
Oh
we
yes?
do. Yeah.
Okay. Oh, okay. Okay. Yeah, because for me I can't see. Yeah. This question killed you. Yeah, I saw someone posted a question. Yeah, that question seems like they really want to get you to use Excel to do this. Okay. Yeah. Okay. Um, yeah. Hmm. So in terms of the exam, right? Um, of course, more information will be given by the school. But as of last semester, how it's being done is that it's also in a lockdown browser, and then you have your Excel, and then basically what you need to do is copy and paste your workings into Excel. However, it's not only MCQ. I think now it's only MCQ. So it's more short answer questions. So there's as of last semester, if they maintain the format, then there is no MCQ at all.
Sorry. Is it going to be open book also?
Yeah, open book.
Okay, okay,
Yes.
okay. Yeah,
Yeah, but
thanks.
that's as of the last semester format lah. Because if you realize, right,
Yeah.
this semester they changed a lot of things. Like even I believe not only for this module, other modules they also changed a lot of stuff.
Oh, okay, okay.
Uh,
Yeah, okay.
hand yes, it, so yes, you're right. It's a handwritten exam as of last year. So you copy and basically you copy and paste like let's say PV. You basically just write PV in your sheet and then put the numbers, right? PV 100 comma something something comma 2 comma something, and then like you just put it in your written exam. Yeah. Okay. I can see very negative feedback on this exam, not exam, the test, the quiz portal. Yeah, okay. I heard your feedback. Let me relay this back to the course coordinator. So yeah. Because like for this quiz, um like even for me, I can't see your grades. At the same time, also, it's coordinated directly by the school and the course coordinator. So like all this feedback is very important. Because sometimes they might not realize that these are issues that they face, especially if you do an online quiz. So yeah, these are good feedback. Okay. Any other last few feedbacks? Okay. Yes, yeah, you have to so basically right, what happens is that your Excel is just like a calculator for you to calculate, and then basically everything has to be written on your answer sheet, which is a physical paper for your final exam. Yeah. So previously, um Excel was not really well, that's quite a while back, but way back, like a couple of years back, you can't even use Excel, so you need to use financial calculator, and then that was a pure like open book but no computer. Then after that they stopped financial calculator and then they have Excel. So that's why your Excel is basically your financial calculator and it helps you calculate. And then everything has to be due written on the paper. Okay. Yeah, even the wording, yeah, it's a bit strange. Okay, so regarding whether we can go through your questions, let me just confirm this with the course coordinator. If we can, I'll do it next in the next lecture. If not, I'll also let you know. Because sometimes this kind of quiz they are quite strict about it. Like they don't want us to go through the questions so that they can reuse the questions next semester. So let me just check on this and I'll let you know next semester next semester. Okay. Um, yeah, I actually agree. So I for me, because I believe even for the quiz, after you submit the question, right, you don't know which question you got it wrong, which one's right, right? And there's no like answers for you to find out. Like, yeah. So on the aspect, yeah, I think that's not so good in terms of learning. Um, compared to it, it's the TMA because TMA previously is like I'll mark the paper and then I give you feedback on how to improve, etc. Yeah. Definitely hear your feedback on this. Yeah, let me check whether we can go through the questions. And if we can, I'll definitely go through the questions and then we can discuss the questions. Right? Okay. So, on this note, maybe we just kickstart today's lecture. We do have quite a bit to cover. Um, and I think we have quite a bit of people already. So let's kickstart. So, um, thank you for feedback again on the quiz. Sounds like it was very stressful. Timing was not enough. Hear all your feedback in terms of the font as well, and even the wordings. So let me collate this, and then I'll try to get back to you on next lesson when we have the next lecture, and then I'll share some feedback on what the course coordinator says, right, or what the school says, right? Thanks for the feedback. Okay, so today what we're doing is let's just do a quick recap what has happened so far. So recall that we started with more like ratios. We understand more of the ratios. Then after that, that's the first lecture. Second lecture, we did more of like time value of money, and we do all the present value, future value, and then with all the various permutations. And recall at that point of time, right, we didn't really talk much on how we get the discount rate, right? How do we get 5% or 3% discount rate, right? So we just assume, okay, the question say the discount rate is 5%, right? So we left it at that. Now, the third lecture, we went on to understand more about, risk and returns. Then at the last part, we also did a small calculation, well, not very small, but important calculation on the aspect of return on equity, right? We use the SML line, we recall as SML line, and then we derive the equation of line, and then we have this equation that allows you to calculate the return on equity. So having said that, today's lecture, right, I would like to give you a broad overview of what we are doing before we go into nitty-gritty details, like what we always do, right? So the broad overview or the broad understanding of today's lecture is basically calculating this discount rate, right? So back in lecture two, we always assume 5% discount, 3% discount, whatever the question gives you, you just use a discount. In this lecture, we are actually going to derive the discount rate. And that's the whole purpose of it. And this discount rate that we are deriving is basically called the cost of capital, right? In layman terms, cost of capital is how much does capital which is money, cost the company, right? And so this cost to the company is basically the discount rate that we need to use, right? So in today's lecture, basically we are trying to derive this value that we have always assumed or has always been given to us in questions. Okay. So I hope this gives you a broad overview of what we are doing today. Now, so cost of capital basics, basically like what I mentioned earlier, is basically the cost to the firm in terms of the capital funding. So how much does capital cost? Recall your balance sheet. We have asset and liability, and then you have your shareholders' equity, right? So your cost of the capital is basically a combination of um, your shareholders' equity and your liability, right? To give you assets. So the combination of liability and owner's equity is basically your capital. your total capital, which will then be used to buy assets to fund the business. Okay, and so the cost involved in getting some liability or raising some money in the by issuing shares, that cost involved it's the discount rate that we're interested in. Okay, so a firm must at least earn minimally enough to return whatever cost that is involved in raising the capital, right? So, in simple terms, if the firm issues some shares and the shares is issued in the market, there's some cost involved, right? So, at the minimum, the firm must be able to cover the costs, right, to earn some money. So, earlier I mentioned, the last lecture we already kind of covered, or not kind of, but we actually covered how to calculate the cost of equity. One of them is um, the CAT-M model. And then this dividend growth model, right? Let's just think about it a bit more, right? So there are two methods. We actually covered this dividend growth model in lecture 2. So hope you do, given that you just studied for your quiz, I hope you do recall what is this growing perpetuity formula that we did, where this growing perpetuity formula in lecture 2A is given by D1 or the cash flow in year 1, right? So it's 1 year later. Remember this is very important, 1 year later, divided by the return on equity minus the growth rate, right? Because the growing perpetuity keep on growing forever. And so if we just do some shifting of the algebra, we can actually make RE, which is the return on equity, as the subject, and this gives us this component here, right? And in lecture 2, we already covered this, so it's just this is a quick recap, right? And so this is basically the return on equity using the dividend growth model. Highlight again, D1 is dividend in year 1. And so if the question gives you dividend in year 0, please multiply by 1 year of growth rate. So I'm going a bit fast because this one we can't cover in lecture 2 already, right? We have a small little example here. Your company expects to pay a dividend of 4.4 per share next year. Okay, so question to all of you, is this D1 or D0? D1, you're right. 1. Okay, I do see a question. Let's go through this example first, then we answer the question. Dividend have a steady growth rate of 5.1% per year. Current stock price is this. So based on the formula, we just take 4.4 divided by 50 plus the growth rate of 5.1%. Okay. Using your dividend growth model. I do see a question here. If I want to find the dividend for year 5, do I need to find dividend year 1 to year 4 first? Yes, okay, so depends on what method you do. So let's say the dividend is growing at G, right? So let's say you have dividend D naught, so dividend year 0. So you have dividend year 5, then you can just multiply it by 1 plus G to the power of 5, right? You just multiply it 5 times, like you compound it, right? You're just compounding it 5 times to get D5. Hope answer the question on that. Right, that's good. So on the component of G, one method, recall lecture 2, we also talk about the sustainable growth rate to calculate G. Anyone can recall what is the formula? I know it's a while back, but anyone can recall what is the formula for the sustainable growth rate? I believe it was covered in lecture 1. R ROE, remember ROE multiplied by what is it? The retention ratio. That's right. That's right. RA times retention ratio. So that's one way to calculate your G, right? So now we are really pulling in all your different knowledge that you have in lecture one, lecture two. So you can calculate G using that, or a simpler method, if you have a historical growth of dividends, we can simply just take the average, right? You find what's the change of the dividends for every year, and then you just take a simple average. Okay. Some disadvantages for dividend growth. Of course, it's easy to understand. However, it's only applicable for firms that actually really issue dividends. Of course, if it's a private firm, you have no dividends issued, then you can't use this. Another important thing is that it's extremely sensitive to growth rate. So in this sense, if you notice, right, I'm just going to flip back here. Can you see that you're adding the growth factor here, right? So it's very sensitive. Imagine this is 10%. So you're going to add a lot, Yeah. So you're adding. So it's very sensitive to growth rate. So you need to calculate your growth rate carefully. Okay, we do have one more question here. So Lotec just issued dividends of 1.8 per share. Question, is this D1 or D0? D0, okay, very good. Everyone is clear on this. Company expects to maintain a 6% growth rate. Stock sells at $41. So we tested 1.8 divided by 41 plus 6%, right? Oh, and then you must multiply by, uh, almost forget. So 1.8 multiplied by 1 plus 6%, right? Or 0.06. Because here's D naught, so you need to make it D1. Okay. In the last lecture, so this one probably a bit more fresher. In the last lecture, we talked about this CAP-M model, or that we kind of actually went into a lot of detail to derive the CAP-M model using the equation of line on a SML graph. So just want to recap to you. This is the return on equity using CAP-M. Important thing to take note is what is this called? Anyone know what this called? This particular term? Expected return on market. That's right. Risk premium, that's wrong. Just be very careful. And that's why I wanted to highlight this again. So this expected return of market, you are right. And then what is, so it's not market risk. Please take note, it's not it's not risk premium. It's not risk premium. It is expected return on market. And then what is this combination called? This term. These two terms combined together is called what? Anyone like give it a try? Risk premium. Now you're right. It's correct. It's risk premium now. So please be careful when you read questions. Please see what they give you, whether it's the expected return on the market, or market return, we call it market return for short, or they give you risk premium, right? So please be very careful on this. So this is a quick example here. We are given beta, we are given risk-free rate, we are giving market risk premium. I will put a star here because we are giving the premium already, risk premium. So how we calculate cost of equity? We take 3% plus 1.2 times 6%, right? Because we are given the market risk premium. Okay, just for like a broken record, I just want to highlight again, market risk premium means that you are given this chunk of thing. So you just multiply it by beta. Some advantages, disadvantages. We kind of went into a bit of detail in the last lecture already, so this is a quick one. We kind of adjust for systematic risk, unsystematic risk are diversified away, applicable for all companies as long as they have a beta. Some disadvantages, of course, we need to estimate beta. That's the main thing because beta will drive the equation. We rely on past to predict the future, which might not be too reliable. So it's best must estimate the expected market risk premium, which sort of varies across time, right? So sometimes it might be a bit tough to estimate this market risk premium. We do have a question here. So first part is imagine you have this company has a beta of 0.9. The market risk premium is 7%. T-bill is currently giving a yield of 3.5. So question, when T-bill is 3.5, what does this 3.5 represent? Inflation, that's right. Another thing, so inflation means that is actually the risk-free rate. Yeah, remember? So remember the T-bill tax to inflation and it represents risk-free, right? Risk-free. One more question. Risk-free, what is the beta for a risk-free security? Remember, there are two important betas that we need to remember. Yes, you're right, 0. And then what is the beta for a market return? 1. That's right. So those are two important betas that we need to know. Risk-free 0 beta, market return is beta of 1. Right? So in this example here, this company has a beta of 0.9, means that it's less risky compared to the market. Okay. Now, they most recently gave a dividends of 1.8. I think this one I will not ask you again. This is basically 0 because most recent. Dividends expected to grow at 5%. Current stock price is 0.7. So they ask you to calculate what is the cost of equity. And in this case, we do both methods. So we use we calculate both methods and do the average, right? So we use the dividend discount model first. We have 1.8 multiplied by the growth rate of 1.05 because this is a D naught. Each divided by 0.7 plus the growth of 5%. And on your CAPM side, now we know that T-bill is risk-free, right? Equals to risk-free, 3.5% plus the beta of 0.9. They already give you market risk premium, so just times 7%. I hope all this is a bit of a recap. And then once you calculate both the dividend discount and the CAPM, you just add it together, divide by 2 to get your average here. Okay. Before we go to bonds, any questions? So this is a bit of a recap of what we have done, but now we're just consolidating it and to show it to you that, Okay, all these equations that you learn in last lecture, and even in lecture um, 2, these can be used to calculate the return on equity, right? And return on equity is one component of the cost of capital, right? So we have tackled the equity component. Now let's tackle the liability component. And this is where we talk about bonds. Again, it's going to be a small recap of what we do in lecture 2, right? So we might go a bit faster on this, but if you have questions, do not hesitate whether to unmute yourself or just put your group chat on the chat. Okay. So bonds, let's formally understand what is a bond. So a bond basically is, in simple terms, right, layman terms, it's just a piece of paper, right? So what is this piece of paper? So you are actually giving your money to a company, and in return, the company is going to give you a piece of paper, which is called bond. And this paper just says that, oh, you have given $1,000 to a company, and the company is supposed to return you that 1,000 after the maturity period, right? So in a simple sense, it's an IOU. It's just a piece of paper that's given from the company to you when you give the money to the company. Okay, so there are some characteristics of a bond. Bond are generally there's this bond holder, debt holder. So if you receive a piece of paper, you are a bond holder because you hold the paper, right? Generally used for financing projects and operations. Bonds are mostly traded over the counter or privately between borrowers and lenders, right? So these are the some characteristics of a bond. There are more characteristics, bond is kind of like we call it a fixed income. So it's not fixed income. Why is it fixed income? Because remember, your bond gives you bonds. Bonds, if you recall in lecture 2, I kind of try to explain to you that the coupons are like interest that you get from the bonds, right? Yeah, you're getting interest from the bonds because at the end of the day, you're still, let's say, if you give 1,000 to the company give you a piece of paper. At the end of the day, the company, when you return the paper, the company is going to return you 1,000, right? So where is the interest coming from? It's coming from the coupons that you get. That's the unique part of a bond. Bond has a maturity, okay, and must be fully paid back. Possible for the company to default, meaning that eventually it cannot pay you the principal back. When you return the paper, the company say, "Oh, I don't have the 1,000, I can't pay you." So it's possible, and in this case, there's a default that happens. However, it's very unlikely. For default, usually the company will just reissue another debt, right? A new debt that's been reissued. Um, this is just more for understanding kind of just a bit of theory. You don't really need to really memorize it. But there are just a couple of bonds. There are corporate bonds, municipal bonds. So corporate bonds are from issued by companies. Municipal bonds are issued by the municipalities or basically states. So in Singapore, of course, we don't have a state, but like imagine the US. Let's say the state of New York, the state of Washington. They can issue bonds at their state level and not the federal level. In Singapore, there isn't such a case. Of course, the nice thing about municipal bonds is they are generally tax-free, um, which is nice. But in Singapore, of course, all capital gains or dividends are already tax-free, right? So some differences between Singapore and the US. Municipal is more for the US. We do have some specific names of bonds. If it's 1 year or less, is called T-bill. Oops, something here. Ooh. Something is wrong. So it's just the last few comments. This is one. So if you have your slides in front of you, hopefully you can still follow. I think there's some error. But if it's 1 to 10 years, it's a note, and then anything more than 10 years called a bond, right? So there are some of the specific names, but generally we just call everything a bond. right? But if you want to be very technical, let's say it's less than 1 year for a T-bill, right? Last point here, which you can't see here, is that there's this agency bond. Again, in Singapore, we have this, but they are not issued for us to buy. Like us as retail people, usually they're issued to another company. So you have like bonds from like LTA, HDB, but they are generally issued to companies, right? So you can't really buy it as an individual. Other characteristics of a bond, we have this thing called the face value, which we kind of talk about. And this is like your FV, how we can recall. This is as 1,000, usually 1,000 FV. You have your issue price, which is generally your PV for the bond. Remember when we did the bond calculation. And last but not least, you have this coupon rate, which is given, which is your PMT, right? Whenever we calculate PV of a bond or the issue price of the bond, we need to put in the PMT because that's where we get interest. Last but not least, we do have this thing called yield to maturity, which is like what is the interest on the bond, like what's the interest rate on the bond. So we already did this calculation in lecture 2, where I kind of elaborate like, okay, the yield to maturity is very different from the coupon rate, right? Those are different. Coupon rate basically determines the PMT, but your yield to maturity is basically your IR, right? In your Excel formula, IR, which is your interest rate. And then last but not least, we have your maturity date, right? It's your N, your basically your N in your Excel. Okay, so I'll pause for a short while. Any questions? I hope it's not too fast because this is more of a recap. But any questions? No. Okay, thank you. So no questions. Okay, so now, determinant of coupon rate. So we have two key determinant on the coupon rate. Basically, is how much interest you get, right? Because your interest is where your coupon is where your interest are coming from. So there are two main things: time to maturity and credit quality, right? So the idea is that if it's longer time to mature, meaning your bond, right, 5 years to 10 years, right? Let's just think about it in a simple sense, right? Imagine if you're going to lend the money to someone for 10 years versus 5 years. If you are going to lend for 10 years, will you expect to receive more interest or less interest for 10 years? You're going to give for 10 years. More, right? Yeah, that's right. So in the same sense, a bond, if it's longer maturity, you expect more interest. Okay. Now, second one is credit quality. So credit quality is how likely the company is not going to pay you back the money, right? It's going to default and not going to pay you back. So question, if you determine that the company is highly likely to not pay you back, will you want to charge more interest or less interest? More, right? So yeah, you can see, right? So this is quite intuitive, right? So it's like, okay, if bad quality means you're going to charge more. So this is totally right. So you already kind of understand this concept. So in this sense, your bond, if it has more maturity, the yield which is your IR component of your Excel, your yield or your interest will be higher. Okay. And next one is your credit quality. So credit quality, there are a few like credit firms. They are called S&P, Standard & Poor's, Moody's, and Fitch, right? So these are like rating agencies that would determine how likely the company is going to default. So they do like ratings for company to say like, okay, this company is highly likely to default, or this company very unlikely to default, right? So they do like this kind of analysis. Okay, there are some comments here, but then I'll just go to the next slide to show you, right? Let me just show you this. So let me just show you this first. So there are different grades here. So let's say S&P and Moody's give you this kind of grading scale AAA, BBB. So all these are like investment grades. These are so-called speculative or junk bonds, right? So they do have some elaboration of what it means. So the idea is that, let's say your credit quality drops, right? And as you mentioned, you may come answer a question. If your credit quality is very lousy, you expect higher interest, right? More interest. So you can see as your credit quality drops, you get more and more interest. Okay. And of course, if your credit quality increase, unlikely to default, means that you get less and less interest. Okay, last but not least, we have a relationship between bond and interest rate. So the bond price, I would just like to write here, this is the very important relationship. So the bond price is inversely proportional to the interest rate I, right? So meaning what? When the interest rate decrease, interest rate environment decrease, the bond price increase, right? So inverse proportion. So these are very important characteristics of a bond, right? So in this sense, let's say interest rate rise by 11%. If interest rate rise, the bond price fall. Now, if interest rate fall, the bond price rise. So it's an inverse proportion relationship. So this is one of the key characteristics of bond between interest rate and the bond price. Okay, so in this graph, what it's trying to show you is that, okay, there are two kind of bonds, right? There's one 30-year bond and a 1-year bond. Okay, so how does this 30-year and 1-year bond fluctuate whenever interest rate changes? So we can see that generally, because your 30-year is a bit more sensitive to interest rate, you can tell that how I say it's sensitive because you can see that the gradient of the 30-year is steeper compared to your 1-year, right? Your 1-year is gentle, your gradient is very gentle. So your 30-year bond is more sensitive whenever interest rate change. And we can see here, right? Can you see that the decrease in the price of the bond when interest rate increases is more drastic for the 30-year? It changes a lot from 1,768 to all the way to 502, right? Versus the 1-year where the fluctuation is only less than $100, right? From 1,047 to 916, right? So less than $100. So we can see that a 30-year bond is more sensitive to interest rate changes. Okay, we do have other characteristics of a bond. Most of the time when we think about treasury bills, they are considered zero coupon bond, meaning what? There is no coupon that is given to you. So basically, the interest that you get is based on the changes in present value to future value. What does it mean? It means that maybe you buy the bond for 900, okay, present value. You at the end of the let's say 2 years, you're going to get back 1,000, right? So there's an increase of $100, and this is your interest, right? So this is zero coupon bond. Now we have a callable bond as well. So what does this mean? Let's try to think about it. A callable bond. So how I like to think about this is if something can be called, means that it can be called back to you. So you call it back to you, means what? The issuer of the bond can take back the paper that he give you. Remember, the bond is a bit of paper, right? Means what? The issuer, the company, can say, I want this paper back. So you take back the paper and give you back your money. Now, in this case, is it beneficial for you or is it beneficial for the company? Yes, you're right. It's beneficial for a company, right? Because the company can just anytime say, I want to take the paper back and then give you back your money, right? But what if you do want to invest? So, because it's beneficial for a company, there must be higher yield to maturity for this bond, meaning higher interest. The company must give you more interest on this kind of bond that is callable. Because you see, the issuer is given option to call back the bond. So it's beneficial for company. So if it's beneficial for company, you must be given more interest because it's not good for you. Now, on the reverse side of things, this thing called puttable bond. What's a puttable bond? Means what? The bondholder, how I like to think about it is I can put the bond there to the market to sell. So that's how I think. So puttable, you can put the bond to the market to sell. Means what? You have the right to actually sell the bond back to a company. And in this case, is this beneficial for you or is it beneficial for the company? Yeah, for you, right? For me. Yes, because anytime you can say, I want to put the bond back to the market and sell it away. So in this case, the yield to maturity must be lower than a normal bond, non-putable bond, a normal bond, right? So I hope you can see that these kind of things you don't really need to memorize, but you can kind of understand the concept, right? If you put the bond there, means that you have the rights to do it, means you're going to get less interest. Okay, last but not least, we have this thing called the sinking fund provision. So what's this sinking fund provision? It is basically a fund where the company sets aside money to pay back the bond when it matures. So usually, why people have this sinking fund provision is that this company might not be so credit worthy, means that it can default very easily, but you still want to issue the bond. And in order to do so, usually the bond holders, which is you giving the money to the company, will request for the company to have this sinking fund provision so that they know that eventually when the bond matures, there's a pool of money that can be returned. And so because this is beneficial for you because you know that there's a pool of money that can be returned to you at maturity of the bond, this will have a lower coupon, right? So it's the same concept because it's beneficial for you, means that it's going to give you lesser interest. Okay. Now, other characteristics of a bond, we have this thing called premium bond. So what's a premium bond? So let me draw this graph here for you. Okay. So this is the bond price of, let's say, 1,000, right? This is bond price. This is maturity. Okay. So a premium bond means that the initial price is higher than the final price, which is usually 1,000, right? The future value. So what it means is that over time, the price of the bond would drop, will keep on going down until maturity where it reach 1,000. This is a premium bond. And how do you determine what is a premium bond? Is when the coupon rate is more than the yield to maturity. So when you see a bond with higher coupon rate compared to yield to maturity, this is a premium bond. Means that the price of the bond is more than the par, which is the future value, which is why the bond price will decrease over time and until maturity, it goes to the par value, decrease over time. You know. On the flip side, we have a discount bond. A discount bond means that it's being sold at a lower price. So, for example, it's being sold here, and it means that the bond price will increase over time to par value. The bond price initially is less than par. And last but not least, the coupon rate is less than the yield to maturity. Okay. We do have some small comments here that I would like to highlight to you, which is quite interesting, is that a bond yield can be negative. Why would anyone buy a, a, a bond yield which is negative? So, an example here is this German bond, which a coupon of zero is being sold at 100 euros, but sorry, the face value is 100 euros, but it's being sold more, is 103.61 euros. And if we do the calculation, yield to maturity is negative. So the question is, why would anyone buy a negative yield bond? So there's a few scenarios that are kind of highlighted here. First of all, maybe this bond is issued by the central bank, and sometimes, when the bond is issued by central bank, certain companies require to hold certain percentage of bond from that central bank. So no choice, they have to buy it. That's why it's a negative view. Negative view means that you're actually paying the company to take your money, right? So it's a bit funny, right? Imagine you have to pay the company to take your money. So it's a bit funny, but it's possible for central bank. Second thing, you maybe buy a negative yielding bond, uh, assuming that the yield will fall, thereby making a small profit, right? So remember, when interest rate environment changes, your price of the bond might increase, and so maybe you can make a profit out of it. Okay. Uh, so having understood bonds, we can now determine the cost of debt, right? So again, this is what we have already done in lecture 2. So one method is to use the yield to maturity or your IR formula in Excel to determine the cost of debt. Second method, we can use the bond rating, which is a bit, not so technical, but it's possible too. So just want to highlight to you again, the cost of debt is your IR, so IR, and it's not your coupon rate, right? So please take note, it's not your coupon rate, it's your IR or yield to maturity, it's your cost of debt. And the nice thing about debt is this very important concept that interest on the debt is tax deductible. So this is, I'll just put 2 stars here. So want you all to really focus on this, it's very important. It means that whenever you calculate your cost of debt, you need to remove the tax. So you take 1 minus tax rate, right? Because tax in your interest based on your cost of debt is tax deductible. Okay, so we do have an example here. We have a 15-year maturity coupon rate of this coupon semi-annual. I'm going to put a star here. So negative interest rate. Okay, so in layman terms, right, negative interest rate means what? It means that, let's say, okay, in simple terms, let's say you want to put money in DBS. Let's say you put $100 in DBS, right? You want to deposit $100 in a saving account. Now, if it's a negative interest rate, means what? It means that DBS is going to charge you, let's say, $2 for putting money into their bank. It makes rate like it's strange, right? Like I give you money to put in the bank, why must you charge me money? But that is a negative interest. So it is not uncommon. Some company does that. Some banks does that. Do we add? So what do you mean do we add? This one? Are you asking about this? No, next slide. Is it this one? Interest is tax deductible. Okay. So interest is tax deductible means what? It means that the cost of debt it becomes lesser, right? What does it mean? Because it means your interest on the debt, you can claim the tax on the interest, you can claim it back from the government. Means what? Because you can claim the tax of the interest, right? Because everything will be taxed, right? If you earn money, you'll be taxed. Your expenses will be taxed. But because interest is tax deductible, means what? The government is going to give you back money if you take on based on the amount of interest you have, based on the debt you have, right? So it's going to give you money. So because the government is going to rebate you some money, give you some rebates on this interest component, that's why your cost of debt becomes lesser. Can you see it's lesser? Instead of 5.2, let's say it's 5.2 times 1 minus 35, right? It becomes lesser because it's cheaper for you. Is tax deductible. Yes, yes. Uh, so if it's a negative interest, that means you pay the government. Yeah. Okay. All right. So this example on cost of debt, that's a great question. Thanks for asking it. So this question on cost of debt, I hope by now I'm going to put 4 stars here because it's semi-annual. So I hope by now we're able to know what it means. So let's see. What is your N? Okay, so I'm going to calculate what is the cost of debt. So what's N for this question? So basically, I'm calculating IR here in your Excel. So what's N? And, no, N is number of periods. So what should I put for N? Semi-annual. So be very careful with semi-annual means what? 15 times 2, 30. Okay, I hope this is clear, yeah, because this is very important. So it really goes back to your lecture 2. So please be very careful. Coupon rate, so PMT is 1000 times what? 1000 is your par value. Recall that in lecture 2, we will say that your par value is always 1000. It's a given. Like in the question, they say you need to know it's 1000. Yeah. Yes. So your payment is 1000 times what's your coupon rate? 12, but are you sure you use 12%? 6%, yeah. Divide by 2. So this is $60. Um, your PV, the present value is negative 1253.75. Your final value FV is 1000 because you're going to get back 1000. I hope the convention makes sense to you because you're paying money out. So negative PV, positive FV. And then you just plug all this value into your rate formula in Excel to get your answer. So very important, uh, again, I want to highlight to you, because it's semi-annual, please convert everything to the lowest denominator. In this sense, it's semi-annual, so you must times 2, and then your payment divides by 2, right? So this is very important. Um, you know, it goes back to your lecture 2. Okay. We do have one more example here. This one a bit more straightforward. So they tell you par value is 1000, annual payment. So this is already very simple. It's annual. Mature in 15 years, willing to pay 950, this present value. But now they give you tax free. So you must make sure you incorporate tax. Okay. So what do we do here? So we put n. This one I'll just go a bit faster because it's a more straightforward. N is 15. PMT is 1000 times 8%, which is 80. Um, Present value is negative 950. Your future value is 1,000, which you are going to get back the money eventually. Um, and then this will give you your rate, right? You use your rate formula in Excel. Now you need to multiply by 1 minus 35% because this reduces the cost of debt for you simply because your interest on this debt is tax deductible, right? So in the end, um, I believe your rate. So this one, if you press your Excel, gives you 8.6%, and 8.6%, you multiply by 1 minus 35 to give you 5.6. So it makes sense because interest is tax deductible, means that it reduces your cost involved in your debt. Any questions? Any doubts on how you do the calculations? Yeah, okay. Do you have a question? When the exam cards are uh, I guess that's why they So in terms of the variation, sometimes certain things that I can't point out, like the semi-annual, is this kind I think it's this kind of things that they try to trick you in the exams, really to see whether you understand, right? So maybe sometimes exam can say quarterly, right? If it's quarterly, I hope you understand you must not divide by 4 or times 4 for a number of periods, right? So exam, yeah, they really want to test you and yeah, to kind of test your understanding, right? Yeah. So there are a lot of variations. So whenever sometimes I really kind of am try to highlight certain parts to you, really put a star there, especially when you do revision, right? To kind of remind yourself that okay, if I see something semi-annual or quarterly, just make sure you put a bit more thought about it, right? Do not just put the value n equals to 12. Think about it. Oh, semi-annual means I need to multiply by 2, right? This kind of small things. So I think it will help, as you go follow a lecture, try to put stars along the way to see that if there are certain components that you need to remind yourself during your revision. Okay. Last but not least, we have this thing called preferred stocks. So we have common stocks and preferred stocks. So preferred stocks generally, you get preferential payments of your dividends, but at the same time, there's no voting rights, right? So these are preferred stocks. They follow a perpetuity because we just keep on getting dividends. Um, and so if we kind of recall your perpetuity formula in lecture 2 is basically your D1 divided by P naught. And this gives you your return on preferred stocks, which is they pay a constant dividends throughout the entire period. Right? So in this example, we have a preferred stock, current price of 36, pays 2.5 in dividends. So the cost of capital for preferred stock would be given by 2.5 divided by 36. Okay, I just want to cover one last slide and then we'll go for a break. As you kind of know already my style, I like to have 2 breaks, so one every hour. But let's cover this last slide first before we go for a break, right? So having understood the cost of equity, cost of debt, which is where we use the bonds, right? And preferred stocks, which is what we covered earlier, very short. These three components basically makes up or forms your capital for the firm. And because it forms total capital for a firm, what this gives is we can calculate the weighted average. So we want to determine what's the cost of capital, but it's weighted average based on various components of either equity, common equity, preferred stocks, and the debt. Right. So you need to weigh it, right, by the percentages. Uh, Important thing to take note, you always use the market value. So please take note this market value. I'm going to put a star here. And what market value means? It means that what's the stock price now? What is the bond price now? What is the preferred stock price now? So the price now. This is very important. Market value. Questions can be very tricky. They can, tell you the historical value. They give you value of the bond 2 years ago. And then they sometimes have so many options of what's the price, then you can't get confused, right? In calculating this thing called WACC, always use the market value of preferred stocks, of common stocks, common shares, and bonds as well, or debt. Okay. Then we have the various components of your calculation, cost of equity, cost of preferred stock, or cost of debt, which we have went through. And last but not least, remember that your debt is tax deductible. So we have this 1 minus T, or 1 minus tax rate. So we have the various weights here. So let's say 5%, not 5%, 50% in common equity, maybe 20% in return in preferred stocks, and 30% in debt, right? So we have all the various percentages. And then we can calculate this thing called WACC, which means weighted average cost of capital. So you weigh accordingly. Yes, they can ask for WACC 2 years ago. So please, if they ask for WACC 2 years ago, please make sure that when you use the market value, it is all the value 2 years ago, not the value now. That's the important part. And we'll go through one question later to show you the importance of picking the right number. Okay. Let's take a break now. If you do have any questions, put them in the group chat, but we'll come back for our break and then we can go through that, right? So maybe we'll come back at around 8:15 and then we'll continue the WACC calculation.
Prof, sorry, just now when you were going through the D0, D1 part, I was on a call, so I didn't really listen. Could you cover that, like, just a fast one?
D0, this one, is it?
First few slides. I think like probably like slide 3 or slide 4, like at the early part of the lesson.
Let's see. This one, is it? This D0?
I think just, yeah, why is it D0 and like what's D0, D1? I totally missed that part.
Okay. So D0 basically, if the question say just issued, right? So that means they just issued the dividends. This is the dividends now. Whenever dividends now is D0.
Oh, so it's like the first dividend, the second dividend, the third dividend. So D0 is like technically the first dividend. D1 is the dividend after the next year, something like that, is it?
Yeah, correct. So let's say you get dividend now, like today. Let's say you get today is D0. D1 is 1 year later.
Oh, okay, can. Thanks.
But why I go through this is because your formula in your growing perpetuity requires D1. So if the question, like what they mentioned here, if the question gives you just, which is D0, we need to multiply it by 1 year to get D1 as seen here, right? So multiply by 1 year growth rate.
Okay, so the 1 point is the 180 per share. The 1 plus 6% is the growth rate. So 1, I will assume 100%, then 6% is technically you plus the 6%.
Yeah, correct.
Okay, can.
Yeah.
Then after
so
you...
this one will give you D1. Yeah.
Oh, okay, can. Thanks.
Yeah, welcome. Okay, so let's take a break. We'll come back at 8:15. Maybe 8:16 is fine too. Yeah. Hi, welcome back. Hope you have just a quick break. Maybe get some tea or coffee. Um, and yeah, go to the toilet as well. So, yeah, just before the break, we kind of went through, WACC. Now let's kind of put this into context, right? And once you see the numbers, I think it will make a lot more sense. Okay, so determining the weight, like I mentioned, we typically use the market market value of the debt, the equity. However, there's this component here that they say generally they want to use the target weight, right? But sometimes very hard to find. Generally just use the market value is fine. Okay, we do have an example here, and this example is being worked out in the next page, so you don't have to copy anything, right? So we are given the stock price now, which is $50 per stock, but we have 3 million stock, right? So it's per stock, so just be careful on that. Cost of equity, COE, is 14%. Preferred stock, we have 2.5 million. Preferred stock, return on preferred stock is 9%. The debt-wise, we have 7.5 million of debt. Yield to maturity is 10%. We have a tax rate of 40% here. Calculate the weight and calculate WACC. Okay, so this example has been worked out for you. Nothing to copy, so let's just have a look. We are given all the various returns. So return on equity, return on preferred stock, return on debt, we are all given here. Now, we find the market value of equity. Just be careful to take 50 times 3 million because we have $50 per share and we have 3 million shares. For your preferred shares and debt, we just put it as it is, nothing to multiply or we find what's the total capital invested. Okay, and then now we plug into the WACC formula, right? We have 150 million of equity divided by the total capital of 250 times 14, which is here. Then you have 25, there are 250 times 9, 5 times 250 times 10. But please do not forget to ensure your debt component is being tax deductible, right? So you need to take 1 minus tax rate. So please do not forget this. In the end, you'll get 11.1. So there are some factors influencing the WACC of the firm. It can be things like market conditions, the firm's capital structure. So basically, imagine if you have a lot of debt compared to lesser debt. So your WACC, depending on the cost of debt versus cost of equity, it might change, right? So your capital structure will affect your WACC. Your dividend policy also might affect because your dividend policy affects your return on equity if you use the dividend discount model to calculate your return on equity. So those things will affect, right? Last but not least, your investment policies as well. Depending on your project or what you're trying to do, you might have a higher WACC compared to the normal project, right? And this is just based on the riskiness of the project. And we have an example to illustrate this for you. Okay, so this question, I will just encourage you to go through. I will not go through this question because the answers are given here. However, I'm actually interested to do this example here because there are no answers given. So I would like to do this one. Okay, so let's see what are the information provided to you here. On the equity side of things, we have 50 million shares, $80 per share. We are given the beta of this. We're given risk premium. I'm going to star here because it's a risk premium. And you are given a risk-free rate, right? So let's just zoom in here. You have the question already. And let's calculate the market value of share. So your market value of share would be your 50, right? Your 50 million times 80. And this will give you your 400 million, right? 400 million. We can use your CAPM model, your CAPM, because we're given the beta, we're given the risk premium and risk-free rate. So your return on equity, RE, is given by your risk-free rate of 5% plus 1.15 times your market risk premium, because they will give you market risk premium, right? So it's not return on market. And this will give you a 15.35% here. Any questions on your equity component? Okay, if not, then let's focus on your debt component now. So your debt component, what is given here? We have a debt with a face value of 100 million, 1,000 million. We have a current value of 1100, coupon rate of 9%, semi-annual. Please, I'll put a star here. 15 years to maturity, 40% tax rate. Okay, so I'm just having kind of already wrote that. Now let's kind of just derive the various values. So we are going to use the bond pricing, right? Your rate formula in Excel. So let's put the various value n. So n is what? Anyone would like me to try? N equals to 30. Very good. So 15 times 2. I hope now you're not being tricked by the semi-annual. Very good. 30. PMT equals to 1,000 times, what is it? 4.5, you're right. So it's 9% divided by 2, which is 4.5, which is $45 per semi-annual. Your present value, what's your present value here? It is given at negative 1100. Yeah, you're right. Future value is given at 1,000 because you're getting back money, right? Getting back in the future, 1,000, so positive in your pocket. And at the moment, current value you pay off, right? So it's negative to you. So you compute your rate. So your rate would be 3.9268%. Please take note that, okay, this is rate, R-A-T. So you punch into your Excel, you get this. Please take note, you need to multiply this by 2 because this rate that you have calculated is on semi-annual basis. So on annual basis, you need to multiply it by 2. And so your rate for your bond is 7.853%. So I want to emphasize this again. You must multiply by 2 after calculating. So don't be too excited after calculating. Okay, finish. Please multiply by 2. So how you calculate the rate? So you go to your Excel. So in the Excel view, type in equals to rate, and then it will prompt you the various prompters, and you put in the various values as per 30, 45, negative 110, and 1,000. Do you need me to go through how to plug into Excel? Yes? Okay. Okay, let's do the Excel. So if you do have some questions on this, I also encourage you for a quick review on your lecture 2B that we have, where there was a recording of lecture 2B. So that will give you a good understanding on your, how you punch things to Excel. So you can state as 2 decimal point, but I encourage you not to round off your figure in Excel. Always use the full value when calculating your WACC. Okay, so now you can see my Excel. I'm just going to pull out the rate formula. So let's see the rate formula here. The first item is MPR, which is your number of periods, which is 30 that we have calculated. Okay, payment is 45. Your present value is negative 1100. Your final value is 1000. Okay, I'm just going to pause for a short while. I hope everyone can get these values on your Excel. I'll pause for a short while here in case you are following me on Excel as well.
Sorry, Prof, can you refresh a bit why the PV is negative 1100 again? Is it just the way Excel requires it?
So remember, whether is it negative or positive is depending on whether money is coming in or out of your pocket, right? So we talk about this in lecture 2. So the key thing is imagine where's the money coming from. So at the start, when you buy a bond, you are going to give your money to a company and the company is going to give you a piece of paper, right? So when money is going out, we are going to give the money to the company is negative. So PV is negative.
So if I'm the one issuing the bond, then the money will be positive. If I'm the one buying the bond, then the money will be negative because my money is going up.
Correct, that's true. That's correct. But always in all questions, it's always from the perspective of you as an individual and you're buying the bond. So it's for you, it's always negative at the present value. And then eventually when you have this piece of paper, you return the paper to a company, the company is going to return your money and the company is going to return you 1000.
Okay.
So it's positive in your pocket.
Thank you.
All right, welcome. So those that are following your Excel, you just click enter, gives you 4% here. Let me just see whether I can increase the number of decimal points. Okay. And then recall that this is not your final value. You need to take this, multiply by 2, because this 3.9268 is just the value semi-annual, but you want the annual, so you'll get this. Right.
Prof, sorry, one more thing. Basically, if you divide by 2, you need to multiply the 2 back. It's like what my math teacher taught.
Correct.
Okay.
Yes, correct. Because the value we get of 3.9268, that is just the semi-annual rate for the bond. But we want an annual rate. So yes, you just need to multiply
If
by
they
2.
say like payment of 15 years, then interest is given monthly, you need to 15 times 12 because there's 60 payment terms, right? Like basically there's 15 times 12 is 600 payment terms. Then the interest rate that they are giving you, you just need to divide by 12 lah. Correct, right?
Yeah, correct. So you need to look at how they're going to compound the value. So let's say they say you're going to compound it on like say monthly basis, so you need times 12. But in this case, it's compounded semi-annual. Because they say coupon is given semi-annual, so it's compounding semi-annual. So you divide by 2 or times 2.
Okay, thank you.
All right, most welcome. All right, so I hope everyone can get this on Excel. I'm just going to jump back to our slides, okay, so that we can see what's next step. Just going to stop sharing. Okay, so we have calculated in Excel. This. Now, this is not the end of the question because we are supposed to calculate WACC. So how do we calculate WACC? Now, what is the market value of your debt in this case? What's the market value of debt? So we have calculated market value of share given here. right? But what is your market value of that?
Prof, can you zoom up your screen?
Sorry, you're a bit soft.
Your screen is zoomed in.
Oh, okay. All right. Okay. So what's the market value of that? Do you want to give it a try? Can you see the full screen now? Can everyone see the full screen or is still cut off? Okay, maybe it's your part. Maybe you just refresh your screen. Okay, so maybe it's not so clear which is the market value. This is the part I want to emphasize to you. The market value of the debt is your current value here. So it's 1100. So this is your market value. It's not your this, not 1000. So please be very careful when using WACC. And remember your weight is based on market value. So you need to calculate your market, use your market value of that, which is 1100. So given that now you know your market value of debt, we know that the total capital is 4 million plus 1100, right? So it is 5100. And then we do the weight, right? So sorry, it's a bit messy, but let me just zoom in a bit here. So we have your equity, which is 45100 times your, just now we calculated 15.35 plus your debt component is 1500 times your 7.853, and I need to take into account your tax rate of 40%, 1 minus tax, because it's tax deductible. So this would be your WACC. So of course, we do this all in Excel. I highly encourage you to always use the full value. Let's say 15.35, right? Usually it's more than 35 something something. Use full values throughout. If not, you're going to get some rounding error. Any questions? So I'm just going to zoom out a bit to let you show the full working. Any questions? So this is a typical question for WACC. So please be very careful in terms of the semi-annual, in terms of what is the market value of the debt. All these are the small things that you really need to be very careful on, especially when questions get a bit more complicated. Because now you see the question is not like in paragraphs, right? It's in like pointers, so you can easily pick up. But sometimes question can be in paragraphs, it's like so much words. So really, you have to be very careful on this. Okay. In the interest of time, I'm just going to move on. If you do have any questions, put down a group chat or unmute yourself, and then we can try to address that. Okay. So in terms of the WACC we have calculated is the average WACC, right? And so what we are trying to do now is we want to adjust the WACC, so risk adjusted. And so why do we have to do this risk adjusted? So the idea of it, right, is that whatever we calculated earlier is the average. But sometimes when we have specific projects, or specific departments or specific segments of the company, they might have different risks. So we need to adjust the average WACC to the risk that they have. Okay, so this is some explanation. You can just read through it, but that's what I'm trying to explain to you. And so how do we do the adjustment? Or why do we need adjustment? So we do have an example to show you, to illustrate why adjustment is required. So what happens if we use WACC for all projects regardless of risk? So we are given WACC of 15%, which is given here, WACC, right? And this is the project return. So IRR is the project internal rate of return. So so in layman terms is what the project is going to give you, right? Let's say project A is going to give you 14% return. If you invest in project B is going to give you 16% return. So that's the return on the project. Okay, so now let's focus on project A. Project A, the IRR or the return on the project or internal rate of return on the project is 14%. So the project is going to give you 14%. Now, your WACC, which is the weighted cost of capital, is 15%. Now, comparing 14% to 15%, should you accept or reject this project? So the project is going to give you 14%, but your weighted average cost of capital is 15%. So should you reject or accept project A? Reject. Okay, I hope everyone can see. You're going to reject it because your project A is giving 14%, so it's less compared to your cost of financing this project is 15%. So you lose 1%. You're right. You're totally right. You lose 1%. Okay, so reject project A. Now, looking at project B, this is a bit more clear, right? Project B is going to give you 16% returns. And then your WACC is 15%, you get 1% profit. You're right. So you should accept. So this is what is shown here, accept or reject. Now, this is based on WACC, which is non-risk adjusted. So because it's non-risk adjusted, we are actually making an error, right? Because we did not consider the project's data. So now let's consider the project's data in the next slide. Okay, so in project A, I was given the beta of 0.6. I was given in the question a risk-free rate, okay, not given, but then we can determine on this graph, risk-free rate 7%. And then I know that my risk premium is 8%. So based on this, we can determine your CAPM, right? Return on the project, which is 11.8%. Okay, so this is a risk adjusted already. Yeah? Now, this is project A, 11.8. So actually, the real risk of the project is actually 11.8% and not 15% based on the WACC, right? The cost weighted average cost of capital is not 15%, it's actually 11.8%, which is lesser. So now, thinking about this, project A, the actually risk-adjusted WACC using the CAPM model is 11.8. Your return on the project or IRR is 14%. So should you accept or reject this project now based on this risk-adjusted? Yeah, you should accept it. All right, you should accept it. Because based on risk-adjusted WACC using the CAPM calculation, it gives you 11.8 versus the return is 14%, which means you get more, right? Now, on the flip side, you use the same calculation, you calculate what is your CAPM for for project B, which is 16.6%. And this means that your risk-adjusted WACC using CAPM for project B is 16.6%, which is higher than the return on your project IRR of project B, which is 16%. So you have a loss of 0.6%. right? So in this case, you should reject project B. So this is being summarized here, right? So this is being summarized here. So based on the risk adjusted, by comparing these two numbers, right? This is using CAPM, right? CAPM calculation. Based on these two, we should reject project B and we should accept project A. Okay, so WCC, how do we calculate 7 and 8%? Is actually given in the question here. So risk-free rate is 7%. The 8% is, yeah, it's not really given. Here, can you see the market beta of 1 is 15. So this tells you your SML line. So I hope you can see. So remember your market return is, remember there's two beta that's important. The first beta is beta of 1 and beta of 0. So beta of 0 gives you risk-free rate. Your market beta is 15. So your risk premium is 15% minus 7%, which is 8% risk premium. So that's a great question. I hope you can still remember how to read your SML line. So, that's a very good question because, in assessment, your exam, it can be like this. They don't like explicitly tell you risk premium is 8%, but you need to be able to understand the concept that market beta is 1. And so if your market beta is 1, your market return is 15 here, and then you take 15 minus 7, give you 8%, which is market risk premium. Is that clear? Is that clear? Because so this is very important. This is very important. It's a great question. You asked a great question. Okay, so this is one way to do the risk adjusted. There are some other methods to calculate your risk adjusted WACC. The first method is a CAPM. The second method is to find a pure play. So what does this? So let me try to explain to you what all this means. It means that you try to find a company that similarly have a similar kind of like segments, the kind of customer, etc. So very similar. And then you try to determine what is their WACC or their beta, and then use their beta to calculate your weighted risk-adjusted WACC. Sometimes a similar company can be very difficult to find. That's one of the downside. The next thing is just a very simple, they quite subjective approach. So the simple way of understanding it is basically you just like this. So you have a graph like this. You can't determine, is this project more risky than your average WACC? If it's more risky, you add 6%. If it's let's say less risky, you minus 4%, right? So it's just based on like some historical data. You determine whether it's high risk, low risk. Low risk, you minus the percentage. You high risk, you add the percentage. So this is more like just on historical data. Okay, so that's all for WACC. We do have some self-review questions. Really encourage you to go through them. And I think some of you all know that as you go through questions, if you do have any issues, when you email me, can't reply very fast. So do not hesitate to email me if you do have questions on self-review part. Okay. Okay. Before we move on, do we have any questions for what we've covered in WACC? Okay, if not, then let's push a bit more before we take our second break. Let's think about this thing called capital structure, right? And the idea of this thing is we know capital structure consists of debt and equity, right? But there's this idea that we can do this thing called capital restructuring. So what does this restructuring mean? So in very simple terms, right, it means that I want to change the percentages of debt to equity. So let's say initially debt is 40%, equity 60%. Now I want to reduce the debt even more. So the debt become 30%, equity become 70%, right? So there's a change in the structure of my composition of debt and equity. And the idea is that, yes, there's a change, but there must not be any change in the firm's asset. So you're going to, in this case, let's say you want to increase your debt or increase leverage, you are going to issue more debt and then you repurchase the share to issue the debt. So use the money of repurchasing the share to issue debt. So net, there's no change in terms of your total asset on your balance sheet. There's no change, but there's the change in terms of the composition of your debt to equity. So that's what you have to do. Increase in capital restructuring. Now, in terms of a decrease in leverage, basically what you want to do, you want to retire or you want to sell off the debt, and then you want to issue new shares, right? So you want to increase your equity and reduce your debt. This kind of want to highlight to you again. Going back to your lecture one, I think we kind of emphasize this a lot of time. The goal of financial management is to maximize the shareholders or stockholders' wealth. And in maximizing the shareholders' wealth, you want to, of course, maximize the value of the company, but at the same time, you want to minimize WACC, which is the weighted average cost of capital, which is basically the cost, right? Is the cost of company. So reduce cost, increase the revenue, right? So that's how you maximize shareholder value. So you want to choose a capital structure that minimizes the WACC in order to maximize wealth. So whenever we take on more debt, right? We take on more debt. The issue with taking on more debt is that it increases variability of both the earnings per share and return on equity. So it amplifies variability. And okay, let's think about it in a simple sense, right? What is variability? Can variability be on the good side or and a bad side? So the question is, can variability be positive? That means you get a lot of profit. And can it also be very negative? It means get a lot of loss. So I hope you can see that variability is both-sided, right? So you can get a lot of profit or you can get a lot of loss. So whenever you take on leverage, you increase variability, which means that you increase the chances of making a lot of money and you increase the chances of you losing a lot of money, right? So let's understand or let's prove to ourselves why would there be an increase in variability when we take on more leverage. So we do have a capital structure given here. We have in the initial one has no debt. Can you see? No debt, zero. Everything is in equity here. Everything is equity. The proposed is you want a 50% debt, 50% equity. So 50-50. So let's try to understand with this proposed, how will this really affect our variability of ROE and earnings per share? So let's have a look here. In the case where there's no debt, we have there's a recession, we get an EBIT of this. There's no interest. Oops, what's happening? Okay, there is no interest, so zero. because no debt, and then we calculate your ROE and EPS, right? Just FYI, I just want to highlight to you that the per share is given here, the number of shares outstanding is given here, interest rate is given here, so we can calculate EPS and earnings per share. We do the same for, let's say, the expected state and then the expansion state, right? So these are the different PB, right? Earnings per share. Now, in the proposed capital structure, what happens now? We have 54 million debt and 4 million equity, right? Because it's proposed. So just want to again flip over to just show you this is the proposed. Now in this case, we will incur a 10% interest on our 4 million debt that we take, right? So we have 400K of interest, regardless of whether it's a recession expected or expansion phase in the market, right? You for sure do need to pay off your debt. Now, because of this, can you see that when we calculate your ROE, because of the interest, it reduces your net income, and when you calculate ROE in a recession phase is 2.5. Now, let's just jump to the expansion phase here. And in this case, you earn 1100K. Now, but because you only have 40%, 4 million equity, your return on equity is so much, 27.5. So I hope you can see based on the return on equity alone that when you take on 50% debt and then left 50% equity, what happens is that your variability of how the range of value of your ROE in a recession and expansion increases, right? So what does this mean? It means that, can you see from here, 6.25 to 18.75. Now, with the debt, it has increased to 0.5, it drops so low, but at the same time, it gets so high to 27.5. So this is a perfect example to show you that debt increases your variability, which means the range of values of your ROE, as well as your EPS. If you look at your EPS value, it's the same thing. Increases the range of value of, in other words, the variability. Any questions on this? Is it clear? Is it clear for everybody on this calculation? A bit blank. No worry, it's all recorded. So, in case you are like feeling a bit tired, you can review. Yeah, I can review the lesson again. Yeah. So don't worry if it's a bit, this lecture form, it's it's quite heavy. Unfortunately, I would say we haven't reached the heaviest part, which is the last part. So don't worry, it's recorded. So if you need, you can go and review a bit. Yeah.
Prof, sorry. So basically, like, if you take on like debt like 50%, then your variance is larger lah.
Yes. Yes.
Okay. Yeah, I
Yeah, and you can see, right, the variance
Yeah.
is larger for here. Let's say this one, this one, this one, this one.
So basically from here is if you earn, if like say your like your EBIT is low, then you shouldn't take on that. But if your EBIT is high, then technically you can take on that.
Yes, you're right. That's perfect. You're right. That's what we're going to cover next, actually. Yeah, you're right. Okay. On that note, see, leverage is beneficial when EBIT is high. So you totally right. You said the findings, right? The summary is that EBIT is leverage is good when EBIT is high. Leverage increases the expected return. Shareholders exposed to more risk in higher leverage. Look at the variability. If there's no debt, is this, but with debt, can you see 2.5 all the way to 27.5. So the EPS side is same thing, increase the variability as well. So when you take on more debt or you take on more leverage, we call it leverage, it increases the risk to the shareholders. And remember, when you talk about risk, is positive risk and negative risk, right? Positive means that if economy is good, when the EBIT is high, you get a lot of money. But at the same time, when economy is bad, you lose a lot.
Of ROE is return on equity, is it?
Yes, that's
So
right.
that means if say like technically here, your ROE high, your EPS high is a good thing, right? Your earnings per share is higher, your return on equity is also higher.
Yeah, that's right. So higher is better. But at the same time, when you take on more debt, you can get very low as well, right? You see it goes very low also. Much lower when compared to a situation where you have no debt. Okay, so given that we have this debt, no debt, right? I guess the next question is, what is our break even? What is the middle part where we are not concerned about debt and no debt? And so the way to do it is, in this case, we have an EBIT. In this case, there is no debt, right? 400, we are using the EPS, so 400K is the total equity. In the case where there is debt, remember that we 50% is debt, so we only have 200K of equity left, but then we need to pay an interest of 400K per year. And so by equating both sides, the debt and no debt, we are saying that what is the value of equity that we are, the value of EBIT that we are not concerned of whether we have debt or no debt, because it's a break-even point. And so we do some algebra, we calculate that is 80K. But what I'm interested, so this is important calculation. I would like to show you how we see on the graph, right? So yeah,
The 200K is from where again? It's half of what you have left, is it? Because total your EB is 800K. So like but I don't get the 200K part.
no, your total EBIT is 400, remember? So it's a continuation of this question here. So um your total is this one, 800.
Ah,
It's 8 million, but then we just
yeah.
remove this. Yeah. Actually, good. I think good point. There is some. Yeah. Oh, yeah, right, correct. 400, sorry, not this. 400 here. 400 number of shares outstanding. 400 versus 200 here.
Oh, okay.
Yeah.
Oh, okay, okay.
Pointing the wrong thing. Yeah.
Thank
Because
you.
you're calculating earnings per share, so it's
Oh,
per
okay.
share value. So this is your value of the share below. It's a
Okay.
value. Yeah, number of shares.
Oh, okay. So like technically your EBIT you divide by the number of shares, you get your earning per share. But now that you got debt, you need to minus away your debt. Then the 200K is like what you have left with lah, because you issued the rest as shares.
uh so 200K is the shares that you left, and then because you have 50% of it is debt. So
Okay.
this is where the case of 50% debt.
Okay, thank you.
All right, welcome. So pictorially in a graph, what are you trying to say? So I think you mentioned a good point earlier that when EBIT is high, you should take on debt, right? So once you determine the break even here at 800K, we know that when EBIT, which this is EBIT, right? This is EBIT, earning before interest and tax. When EBIT is more than your break even, you should take on debt. Advantage to take on debt. Now, when your EBIT is less than 800, this is disadvantage to take on debt. So it's not good to take on debt. So once you determine the break even, it's a good way to see when you should take on debt and when you shouldn't take on debt. We do have a question here. So we have this company comparing two capital structures. Plan A, which is an all equity, or plan one, and plan two, which is a leverage plan, meaning that we have some debt. Okay, under plan one, Carl would have 400k shares of stocks outstanding. Under plan two, there will be 260k shares outstanding, and 6020 debt outstanding, and this debt will incur an interest of 10%. Here, we will not be considering tax at this point in time. So the question is, if EBIT is 1.3 million, which plan will give the highest earnings per share? So in this case, we can calculate plan one, where it is 400k shares. So we take 1300, which is this, right? Divided by number of shares, we get EPS of this. But in the second plan, because we will incur some interest, we will have interest on the debt that we have taken, which is 6020. Okay. And therefore, the EPS is lesser, divided by number of shares is lesser as well, and this gives you your EPS of 2.68. And in this sense, we can say that we see that for plan 2, the EPS is less than plan 1, and therefore leverage is working against the company. In the second case, when EBIT is 2.1 million, we do the same calculation again. I'll not repeat it, but we can see that in plan 1 is 5.25 and plan 2 is 5.76. And so in this sense, we know that plan 2 is going to give a higher earnings per share, which means that leverage is working for the company. Last but not least, again, we calculate what is the break-even point. The break-even point, we let X be the break-even EBIT. We use the same formula. Recall that you need to minus away the interest for this plan where we have some debt, and of course, this plan is no debt, right? This one, no debt, 100% equity. And we find that the break-even point is this value here, 1720. And this makes sense, right? If you go and compare it with here, can you see here? When it is 1.3, which is below the cross, remember the graph that we have drawn earlier? When it's this the break even here, break even is here, right? When it's below break even, it is negative again for you to take leverage. But when it's above here, it is positive for you to take leverage. Okay. So conclusion, if EB is high, good to take leverage. If not, do not take leverage. And in general, leverage increases your variability or the range of value of your EPS and ROE. Now, there is a comment here, right? And the important comment. The question is, so does leverage affect the firm value and WACC? So this one, right, whatever we're talking about before we go to this portion here, is that we're just looking at the firm by itself. Now, we are going to, the next step, we're going to take a global view. So we're going above the firm and say this. What if we consider our own leverage with the firm? So combine the firm, our investment, and the firm's investment. So take a higher global view. And this is where we have this thing called homemade leverage. Okay, so I'm going to repeat this again. This is an important concept that you need to understand. Before we even mention this part here, everything has been just focused on the firm. Only look at the firm. Now, this next point here that we talk about called homemade leverage means that we're going to take a global view. So you go up higher above the firm by incorporating your own assets, your own debt into the investment of the firm. Because you're going to invest in a firm, right? So you consider the firm's debt, asset, whatever, together with yours. And so because you do that, you can make leverage, even if the firm has no leverage, because you have combined your own money and debt at the same time with the firm's equity and debt. So the thing is, the reason why is that shareholder can adjust the amount of financial leverage or borrowings on their own, right? So you're taking a global view.
Prof, sorry, for this one, do you have like a, I don't know, a real life example or something?
Yeah, there is an example coming. Yeah.
Okay.
So what does this mean? There's a good follow-up. So homemade leverage. So let's say you want to increase your leverage, you're going to borrow some money and buy more shares, right? When you borrow money, increase the leverage for yourself and the firm as well, because you're taking a global view. Now, if you want to unleverage it, you sell some shares and lend the money out, right? So we're going to reduce the leverage on your end, but at the same time, if you take a global view, means that the firm leverage has been reduced. There is an example coming up. So we are going to use the same example. This is just a repeat of the other slide. I just copy and paste to let you recall what are the values given here. Okay. And then we have a situation of debt without debt. This is just the same thing. I just copy and paste to just highlight the values. Now, this is the part of homemade leverage that I'm interested in. So, in the case where the firm has debt within the company already, right? There's debt. So, let's say you as an investor, you buy $2,000 worth of shares, which is 100 shares, right? So, in a recession phase, your we know that the various EPS is given here, right? The EPS in a recession expected and expansion phase is given here. So 0.5, $3, and $5.5 per share. Now, given that we purchased 100 shares as given here, what is our earnings? So the earnings is 100 times 0.5 in a recession, 100 times $3 in a expected, 100 times 5.5 in an expansion. So we get the various earnings that we have achieved. Okay, this is a case where the company took on debt. Now, of course, now let's look at a case that when the company do not take on debt, so company has no debt, but we make our own debt. So what do we do now? So that as an investor, we borrow 2K at 10% interest and use this money that we borrow to buy the shares of the company, right? We buy 200 shares at $20 per share. Okay, again, we are given the various EPS, but this EPS you see is different from the EPS that we have seen earlier here because this one has debt in the firm, this one has no debt in the firm, right? So no debt, we know that the variability is less, so the EPS are different. But with the EPS value, we can calculate the earnings in the recession phase, right? So we have bought 200 shares. So 200 times the EPS of 1.25, right? Then we have to always take away the interest that we have to pay for the amount that we have borrowed in order to buy the shares. So we do the same for the expected phase, we do the same for the expansion phase, right? As given here, the EPS are all given here. And we determine what is the earnings, right? 50, 300, and 550. And can you see that the earnings mirror each other, right? Can you see it's exactly the same? in this situation where there is debt in the company and there is no debt in the company, but you created your own debt by borrowing money to buy the shares. So what is the summary here? It mirrors off the payoff of purchasing 100 shares of the firm under the proposed capital structure of making the leverage. So in this case, where you make leverage. So it's exactly the same. So at the end of the day, what is he trying to say? He's trying to say that if the firm has no leverage, do not worry, you can make your own leverage in order to get a certain payoff that you want. Any questions? So this is very important. This concept of homemade leverage is very important.
But Prof, this is in theory, right? Because like technically, like physically, even after you borrow the money and then you go and buy the shares, even though the company got no debt, won't the EPS still be the same? Technical, like speaking.
No, not really, because remember that let's say the EPS value here, this one, right, is very specific to the capital structure. So this one, when there is no debt, there's less variability, which you can see here, 1.2 to 3.75, compared to the EPS here, which has the debt is 0.5 to 5.5. So
so you can, so technically you make your own like variability lah, in a sense.
yes.
Okay, thank you.
That's why it's called homemade leverage. Yeah. Most welcome. Okay. So let's just take a quick break. Maybe another 7 minutes break. Before we go on to the last part of today's lecture, which is I think the toughest part. Unfortunately, I know this lecture is a bit heavy, but yeah. Let's take a break. Let's come back at 9:20. And we'll go to the last part of today's lecture. All right, welcome back. I know this lecture has been quite heavy, but hang on there. It's the last part of today's lecture. Unfortunately, or fortunately, it's the I would say quite difficult to understand, but I'll try my best to really make it as simple as possible. Right? Okay, so let's jump into it. So we have talked about capital structure, right? So far we've did calculation for equity, debt, etc. But now let's kind of think of a theory like this. So basically, this theory we call it M&N theory is hypothetical. It doesn't exist, but it's just a theory, and we're trying to analyze the theory. And so we have three different cases of this theory, but in each case that we're going to analyze, so we are going to analyze three cases, right? In each case, we are going to analyze it from proposition one, which is the value to the firm. How does the value of the firm changes? And from proposition two, on how does the WACC changes when we put certain things in the three cases that we're going to talk about. Okay, and when we think about the value of the firm, always think about the cash flows. So whenever I try to think about how does the value of the firm change? Always focus on cash flow. So the question you should ask yourself is, how does the cash flow changes? Right? Is it increasing the cash flow? Is it decreasing the cash flow? And therefore, it will increase the value or decrease the value respectively. Okay, so we have three cases that we need to go through. We have case one, where there is no tax and no bankruptcy. Case two, when there is tax and no bankruptcy. And case three, when there is tax and bankruptcy. And again, I highlight to you, this is a theory, so it's not real. And we want to understand how does these three different cases affects the capital structure that the company will want to have, right? And we need to look at two propositions for each case. So prop A, so I'll just prop 1, prop 2, and then prop 1, prop 2, prop 1, prop 2, right? For each of the cases. Okay, so let's jump straight in case 1. A case 1 is called a case of perfect capital market, means that there is no tax and no bankruptcy costs. Okay, so in prop 1, what is it trying to say? It means that the value of the firm will not be affected by any change in capital structure because the cash flow does not change. Okay, I'm just going to go to the next slide before we go to prop 2 because we want to try to understand it, right? So in case 1, in a perfect capital structure case, in prop 1, where we're talking about the value of the firm, because there is no tax and no bankruptcy, regardless of how how much bonds or debt and how much stocks you take, it's almost like a pizza with different parts of the pie, like cutting the pizza differently, right? But at the end of the day, the whole pizza is still the same thing, right? It doesn't change because there is no tax benefit of taking on debt, and there is also no possible bankruptcy of taking on excessive debt. So in terms of the risk to the because there's no bankruptcy cost, in terms of the risk to the shareholders or the risk to the cash flows, there's no change. So in prop 1, in terms of the value of the firm, in case 1, where there's perfect capital structure, there is no effect of whether you take on more debt or more stocks. Okay, so just sort of small comment. In case you need to leave or you have arrived late, do not worry. All the lectures are recorded, so you can go in and rewatch the parts that you missed. Okay. Okay, right. Now going to prop 2. Remember, for every case, we want to determine prop 1, which is the effect to the firm value, and prop 2 is WACC. right? So in Prop 2, they say that the WACC is not affected by capital structure. Okay, so in this part, we need to prove a bit of stuff, right? So we cannot just say, we need to try to understand it from a mathematical perspective. So there's a lot of, it's quite a lot of stuff here. So let's try to dissect the information, right? So these are written very nicely for so that when you revise, you can kind of understand. But let me try to dissect the information for you. Just look at here first, right? WACC is given by this formula, right? We know about this already. We have studied it in our first part of today's lecture, right? It is the value of the equity times RE, the value of the debt times RD. Now, let's equate this to this thing called RA, which is the cost of the firm's business risk, or the risk of the firm's asset. Okay, so WACC equals to RA, which is the cost of the firm's business risk or the risk to the firm asset. So I'm just going to flip to the next few slides to just elaborate to you what is business risk here. So business risk is basically the risk related to the asset. It can be things like sales risk. Are you able to sell? Operational risk. Are you able to operate the company, ensure that there's no fire that's breaking out the company, right? So all these are your business risk, which is equals to your WACC. Okay, so let's go and flip back again. Now, having equated RA to this figure here, to your WACC, I'm going to make RE. So from here, I'm going to make RE the subject. And in doing so, I will get RE equals to RA plus RA minus RD times D divided by E. Okay, so basically I'm just using some algebra to shift it to get this value like this. And if you're interested, this is the steps to get your derivation from your WACC to this thing here, right? So I put a derivation there. You will never be asked to derive. It's just for understanding. It's just shifting algebra. You can try to do it yourself as well. It's just shifting the values here and there, some algebra, and then you get this value here. Now, what I'm interested in is that once I get this derivation, we know that RA is business risk, right? We have already defined that already. And in this sense, whatever that's remaining, this component here relates to financial risk, right? So what is financial risk? So financial risk, right, is anything relating to how operations are being financed. How do you manage your debt, right? When you take on debt, there is some risk in taking on debt. So how that aspect relates to the financial risk of the company. So this component here is given by financial risk. So IE is the additional returns required by stockholders to compensate the risk of taking on more debt, more leverage. So it means what? If you take on more debt, your financial risk is going to increase, right? When you take on more debt, financial risk is going to increase. So with that in mind, knowing that when you take on more debt, financial risk is going to increase, you know that your RE here is going to increase, right? When you take on more debt. And so what happens is when you have a change in capital structure by increasing the equity, decreasing the equity and increasing the debt, so taking more debt, decrease the equity to take more debt. What happens is that your RE is going to increase based on your increase in financial risk that we talk about. right? Increase in debt, more RE, and therefore there is an offsetting that happens when you take on more debt, reduce your equity, and the larger RE. These three components here, I'm just going to use this color, this green. These three components is going to offset each other such that at the end of the day, your RA is going to maintain the same. RA is your business risk. And remember, your business risk, we have equated it to the WACC as given here, right? So what does this mean? It means that when you take on more debt, your percentage of debt increase, potential equity decrease, your RE increase. These three components offset each other such that your RA maintains the same. And RA is your WACC. So this is the reason why we say that the change in capital structure weight EV and DV exactly offset each other when to the change in RE so that WACC remains the same. So remember, we are in a case one scenario where it's perfect capital market. So in this sense, we have now proven that proposition one, which is the firm value, does not change. Proposition two, which is the WACC, we have proven using the financial risk and business risk calculation, the method to prove that it does not change as well because of the offsetting that is happening here. So just want to highlight to you, these are financial risks. I just elaborated what is financial risk right here. So pictorially, what is happening here? So as debt to equity ratio increases, your RE increases because of your fin risk, financial risk. Your RD remains remains unchanged, right? And because of that, there is the offsetting that happens will cause your RA or WACC to remain the same. So maybe the question is like, okay, like you have explained all this. So how do they actually going to test you on this, right? So this one you can look through. I'm not going to go through. It's already worked out because I want to go through this example here on case one proposition two and show you how they actually would test you on such a topic. Okay, so let's say we are given a firm with WACC of 16%, cost of debt is 10%. Right? Suppose the percentage of debt is 45%. What is the cost of equity? Now, for this kind of question, the important part is to identify which case are you in, right? And in this example, it has been placed nicely. It's the case one, perfect capital market situation here, right? It's very nice, very placed for you, right? So given where we know it's a case one scenario, we recall the formula. I'm just going to zoom in a little. We recall the formula that RE is equals to your RA, which is WACC. Remember the formula? So I'm just going to flip over. I'm just going to flip over to show you the formula that I'm talking about. Just going to erase all these lines. So this is the formula I talk about. RE equals to RA plus RA minus RD times D divided by E, right? So I'm going to use this formula because you are in a situation of a case one, proposition two, and the question is asking you what is the cost of equity, right? So I'm going to put your WACC or RA is 16%, plus your RA, which is 16% again, minus your cost of debt, which is 10%. And then you know your percentage of debt is 45, so it's 45 divided by 55%, which is your equity, right? P to E. So in this sense, your calculated value is 20.9%. So this is how they're going to test you for such a question, right? They want you to use this formula RE to calculate your cost of equity. Now, there's a follow-up question. Suppose instead that the cost of equity is 25%, what is the debt to equity ratio? And the first part, what's the second part is what the percentage of debt? So we know that, let's say your RE is 25%, right? So I'm going to use the same formula again. And then you know that your WC is 16% the same. We know that it's 60% minus your RD. Now, the question is, what is your debt to equity, right? They want you to determine your debt to equity like this. So I'm just going to use some algebra to shift it around. And in the end, we can determine your debt to equity of 1.5, which is equals to 3/2. By 2, it's 2, 3/2. So we have determined debt to equity 3/2. What's the percentage of debt? So percentage of debt is 3 divided by 3 plus 2, right? Because there's 3 here, there's 2 here, so the total is 5. 3 plus 2 equals to 60%. 3 divided by 5. Any questions here? Any questions regarding, this kind of a question?
How do we tell when it's case one, like case one, case two, or case three? Is there like any like telltale sign?
Yeah, so in the question, right, they will usually state certain like hints to you to like say, oh, in a, let's say sometimes they use in a perfect capital market. Then you must know it's case one, right?
Oh, okay.
Yeah. So they give you some hints here and there.
If say like I don't know how they mark, but if say we don't have time to go and solve the thing, if we just write it out like that, still got working marks, right?
Yeah. You still get working marks. Yes, definitely. Yeah. So the thing about this theory, right, is choosing the which case. Because if you choose the wrong case, the method you're going to use is different. So then your whole answer is wrong. So let's look at case 2 and then you can't understand because there's different formulas. Okay, so in case 2 is an imperfect capital market, and imperfect capital market means what? You're going to have taxes, but you have no bankruptcy costs. Okay, before you go to case 2, right? For case 1, right? Summary. So summary for case 1. Regardless of how much debt, how much equity, you are not affected, right? Because it's not going to affect your value of the firm. It's not going to affect your WACC. So you are not concerned about how much debt, how much equity you have. Because regardless, it's not going to affect your WACC, it's not going to affect your firm value. Okay, that's for case 1 in a perfect capital market. Now, for case 2, when there is corporate tax, let's look at what happened with tax now. So recall that when there is tax, right, we need to think about the tax deductibility. Remember, even your WACC formula, we have the 1 minus tax at the end for any debt-related kind of investments, or not investment, capital structure. So interest is tax deductible, and this means that you're going to get money from the government because you're going to get some rebate from the government whenever you submit your how much interest you have based on debt to the government at the end of the year. With this, it means that if you have more debt, when you have more debt, you're going to get more rebates from the government, right? In terms of tax deductibility at the end of the year, which means that it's going to increase your cash flow at the end of the year. And this increase of cash flow means that it's going to increase your firm value. Okay. So remember proposition 1, again, we're looking at firm value. So let's kind of analyze this now. So we have an unlevered firm, meaning no debt. So zero interest, right? And then this is the working, right? So we have some taxable income, we have pay some tax, and then your net income here, right? Uh, and then your CFA, which is basically your net income plus any interest, but in an unlevered situation, meaning no debt, you have no interest. In a levered situation where you have some debt, you have 80% of interest that you have to pay. Sorry, $80 of interest that you have to pay. In this sense, you need to, with taxable income, we need to take 100 minus the interest income. Sorry, 1,000 minus the interest income of $80. And then we need to pay some taxes. But then at the end of the day, your CFFA, you need to add back your, so it's your 644, you add back your $80. You get 724. So what does this mean? It means that if you look at it, in your proposition one, remember I was trying to say to you that whenever you have interest, you can get some tax deductibility, which is some cash flow that's coming in, right? And then this cash flow means that you're going to increase your firm value. So in a sense, right, your interest has a tax shield, and this shield is the rebate you get from the government because of tax deductibility. So the question is, how much shield do you get? How much tax shield do you get? And so to determine the amount of tax shield, we take the amount, which is 1,000, times the tax rate, interest rate, which is $80 of interest expense that you have to pay per year. Now, the amount of tax is based on $80 times the tax rate of 30%, and this is the amount of tax shield or additional tax rebate you're getting from the government because you pay interest. So you get $24 of cash flow rebates from the government. Now, if we are going to assume a perpetuity, meaning that we are going to assume that we will keep on getting $24 non-stop from the government, then we can take our tax shield, annual tax shield, which is $24, divided by our return on debt. Right? Remember, what's the formula for your perpetuity is D1 divided by your rate, right? Your rate, which is RD in this case. And so what you get is 300 for your present value of your annual tax shield. And in this case, you can actually see that your RD and RD can cancel off each other like this. And at the end of the day, you can just take D times TC. So you just take your debt. Oops. Sorry. You just take your debt value. Just take your debt value times your tax rate, and this will give you your present value of annual tax shield because your RD and RD cancel out each other like this. So
Prof,
having understand, yeah.
the D and TC that part. That is it.
Sorry, what's your question again?
D times TC. D and TC is what again?
Okay, sorry. So D is your debt, this one, 1,000 times your TC is your tax rate, 30%.
Okay.
Yeah. So have understood this, right? That in a situation of phase two, you get some cash flow in terms of rebate of the taxes from the government. It means that the value of a levered firm, so the value of a firm with debt will be equal to the value of the unlevered firm, so value of the firm without debt, plus any of the rebates, the present value, of course, the rebates given by the government, which means the present value of the tax shield. So with this equation, levered firm equals to unlevered firm plus present value of tax shield. If we are going to assume EBIT as a perpetuity meaning that the firm is going to keep on generating this amount of EBIT in the foreseeable future, for the value of a unlevered firm, which is this unlevered firm here, we can assume EBIT of the EBIT, and then you assume a perpetual EBIT. So we just take the EBIT times 1 minus tax, because there is tax rate, and then we divide that by the cost of capital of unlevered firm. I put a star here. This is unlevered. We are talking about unlevered, so no debt. So once we determine this VU, which is the value of unlevered firm, we just take the VU plus the D times TC, which is what we have calculated earlier. Right, we have calculated here the present value of your tax shield, which is D times TC. And the value of unlevered firm, VU, plus the present value of the tax shield must be equals to the value of the levered firm here. So the question now is, what capital structure is the most optimal? So I hope you can see that the most optimal structure is that you have 100% of your structure in debt. Because whenever you take on more debt, you get more tax rebate from government. Get more tax rebate means you get more cash flow, and this cash flow is determined by the present value of the tax shield. And so if you have 100% debt, that's the best in terms of your proposition 1, and that is in the case of your firm value. So we have a graph here to kind of illustrate this even more. We have a value of the unlevered firm, VU, meaning no debt. So it's given by this, right? Now, as you take on more and more debt, as your debt increases, right, there's an increase because of the value of your tax shield that you're getting. You're getting more and more shield, more and more rebates in terms of cash flow. And this TC times D, a present value of tax shield, increases, and because of this, you get more and more value for the firm. So I guess at the end of the day, maybe you ask, okay, so how are they going to test me on this, right? So let's have a look at this. In a situation where they give you some data on EBIT of 1,000, tax rate of 30%, debt 1,000, cost of debt 8%, unlevered cost of capital 10%. So in a situation where they say this is a case 2 situation, what is the value of an unlevered firm? So I hope we can straight away think about, okay, unlevered firm means that what? I need to use this formula here, right? Value of unlevered firm, assuming a perpetuity. So this gives me, let me just zoom in a little. For unlevered firm, this gives me, I have an EBIT of 1,000. I know that I need to minus the tax rate here, 1 minus 30%, divided by because you're assuming a perpetuity, so you are using the cost of capital for unlevered firm, which is 10% here. Now, with the cost of capital of unlevered firm, can you find the levered firm? You can, right? I'm just going to flip back to the formula here. Remember, the cost of capital for levered firm is just this, right? VU plus D times TC. So I already calculated my VU. So I just need to take 7,000, which is your VU here, given here, plus D, what's your debt value? 1,000 times TC. What's TC? Your tax rate of 30%. And this gives you this value here. Now, the last part of the question is, what is the value of equity? So hopefully by now, if you're able to get first 2 parts, the third part hopefully wouldn't throw you off, because we know that the value of a levered firm, so the whole firm value, right? which is level, is 7300. Now, we know that they have taken $1,000 debt. It means what? 7300 minus the value of the debt they have taken equals to 6300. And this is the value of the equity. This is the equity, right? Because they have taken all 1,000 debt. So I hope the last part of the question wouldn't throw you off like, huh? How come suddenly ask about equity? So this is basically because we already know the firm value, you minus away the debt, gives you the equity value. Okay. We have to push a bit more. We have a bit more calculations to do. We have tackled case 2 proposition 1, right? So now let's talk about case 2 proposition 2. Where remember proposition 2 is always about the WACC. So in this sense, the WACC is given by this formula here, RE equals to RU plus RU minus RD, D divided by E times 1 over TC. So you have to know this formula. Now, the thing is, I'm just going to flip over to case 1. Remember in case 1, I was saying that you can actually prove this formula here, right? Remember, this RE equals to RA plus RA minus RD, D divided by E. So this, the proof is actually here, which is given here, right? But in the case 2 situation, we will not do the proof, but you see the formula is very similar, right? Just that now we need to consider the tax component. So we're not going to do the proof because it's out of your syllabus, but we are going to use the formula given here to do some calculations. Can you see? It's very similar to your case 1, proposition 2. Where your RU is the cost of capital of unlevered firm. Okay, so we have the same example continuing from the previous example. We have the various items here. We know the equity that we have last calculated was 6300. So the question is, what is the cost of equity? So cost of equity, we know that because we're following the last question, we just follow up the next part. Cost of equity, we use the RU. So RU is 10%, right? 10% plus 10% minus 8%, which is your cost of debt. Your debt to equity ratio is, how much debt do you have? 1,000 debt. How much equity do you have? 3,600 equity. 1 minus 30%, because it's 1 minus TC, and this should give you 10.22 for cost of equity. So finally, we go back to the whole idea of what's cost of capital. So cost of capital is WACC. WACC, so it's just the standard WACC formula. So we know the cost of the amount of equity is 6300 divided by 7300 multiplied by 10.22 plus 1,000 divided by 7300. So this is just your WACC. So it's nothing brand new. Your cost of debt is 8%. But remember that now you're in a case 2 situation where where you have taxes. So you need to consider a tax of 1 minus 30% because there's some tax deductibility, and this should give you your WACC of 9.59%.
Hey, hi, Prof. I have a question.
Yeah.
So for unlevered, right? Does it mean that the company took debt, or because in the first example we talk about debt and no debt, right? So in the
Yeah.
second example, is it like unlevered means got debt and then levered means debt included, or how how do you think of?
Okay, so second example, unlevered means no debt, levered means there's debt. Does that make sense?
Okay, then thank you.
Okay, welcome. Yeah, so in case this is a bit too much, do not worry. Really encourage you to rewatch the lecture if need. Because yeah, this part can be a bit technical. And it's very theoretical as well, because it's a theory, right? Okay, so in case two, right, when there is when there is a taxes, what happens? Remember, we say that the more that we take in, the more rebates you get. The more rebates we get, the more cash flow we get. More cash flow means more value, right? So if we plot the graph, right, we see that whenever debt to equity ratio increase, oh, this one doesn't show. Okay, so we know that in the situation of case two, the best scenario is that we want to have 100% debt, right? Because we keep on getting more and more rebates. Now, on the proposition two, on the WACC, we know that as we get more and more tax shield, it will reduce our WACC to the minimum where we have 100% debt. So we see the WACC falling all the way down. So quick recap again. For case one, we are indifferent in terms of the capital structure because having debt, having no debt, we have proven that it does not affect the firm value, it does not affect WACC. Now, in case two, when there is tax, we know that when there is more debt, we get more tax shield and therefore we get more value. At the same time, also our WACC would reduce even more because we have proven that the WACC is given by the RE and that's now the formula here, the RE, this one here, which would reduce your WACC when you have more debt. So in case two situation, having 100% debt is the best structure, right? Last but not least, we have case three. And so case three is the most realistic example, and it's probably the example that you would find that is the simplest to understand, right? So case three is a situation that you have taxes and you also have bankruptcy costs. So it means what? It means that whenever you have more debt to equity ratio, increases the probability of you defaulting or becoming bankrupt, and therefore there's additional costs that is involved in taking on a case, in taking on more debt. So at some point, the additional value of your tax rebate from the tax present value of tax shield, right, is going to be offset by the bankruptcy cost that is going to keep on increasing as well. And so there is going to be an offsetting of the value of the firm and the WACC. And we'll see this in the graph in just a bit, right? There's some comments on bankruptcy costs. I'll not go through them. Basically, you can just read through what kind of bankruptcy costs are involved, indirect, direct, etc. Right? But what I'm interested to show you is this. So in terms of firm value, recall that your firm value is going to increase, right? Because of your tax shield that you're going to get from your debt. present value of tax shield. So it's going to increase your firm value in the proposition 1, right? However, at a certain point, right, your firm value is going to drop because there's going to be this financial distress cost that's going to pull the value of your firm down. So there is basically at the end of the day, it means that there's an optimal level of debt that you must have in order to get the maximum value for your firm. On the proposition 2 side, which is the WACC, similarly, your WACC is going to reduce due to your tax shield that you get, right? You reduce your cost of capital, WACC. But at the same time, your cost of capital is going to increase again because when you take on more debt, there's going to be bankruptcy costs. So, summary for case 3 is saying this. In case 3 situation, there is an optimal level of debt that you must take in order to have a maximum value of your firm value and a minimum WACC given here. Okay, and these are summarized as shown here. No optimal structure for case 1, optimal structure 100% debt for case 2, and there is an optimal structure on a certain percentage of debt, certain percentage of equity for case 3 situation. Understand it's already 10. I would like to just go through one last example in our last slide and then we'll call it a day. I know it's quite a heavy last part of the lecture. Unfortunately, this part has always been very heavy, but if you do have any questions, just feel free to drop me an email and I'll usually reply pretty quickly, right? So let's look at our last example here. We have a EBIT of 19750 every year forever. The company has no debt. The cost of equity is 15%. Corporate tax rate is 35%. So question, is this a situation based on these few key topics? Is this a situation of a case 1 or case 2 or case 3? Case 2. Okay, I see one case 2, one case 3. I hope you can see it's a case 2, because you're in the situation of a case 2. And especially when you see this thing EBIT forever, right? We kind of think, remember case 2, we talk about the perpetuity of the EBIT. So it's a kind of a case 2 situation. So we have the EBIT of 19750 divided by your 15% of equity. Oh, and remember, because case 2, you do have some tax, so you need to 1 minus 35% of the tax rate, right? So this is your growing perpetuity, and this will give you this answer here. 85583. Now, second part of the question, suppose the company can borrow at a 10% rate. If the corporate tax rate is 35, what will be the value of the firm if the company takes on equal debt? Takes on debt equals to 50% of its unlevered value. Means what? It means it's going to take on 50%. Okay, so I'm just going to zoom in here to do the working. So it's going to take on 50% debt. So remember, in case 2 situation, the value of a levered firm is equals to the value of the unlevered firm plus the present value of tax shield, right? So the value of an unlevered firm, as we have calculated earlier, which is this, right? This one, unlevered firm here, is given by 85583. I'm just going to put that. I'm going to put the 0.33. Now then you need plus the tax shield, right? So the tax shield is 35% of the debt amount. Remember, TC times D or D times TC. So the debt amount is 85583 divided by 2, right? because we are going to take on 50% of the unlevered value. And this will give you this. Now, if we take on that value equals to 100% of its unlevered value, which is the most optimal situation in the case 2, because remember we say that in the case 2, whenever you want to have maximize your capital structure, you want to take on 100% debt, right? So you want to maximize this, the value of your levered firm. Again, we use the same formula. So I'm just going to zoom in a bit here. So it's 85583 plus 35% of the maximum value of your 100% of your unlevered. So it's 85583, right? Because you're getting 100% of your debt equals to your unlevered value. And this value is equals to here, 115,537. So I hope you can see that. Can you see that by taking on 100% debt, the value of your levered firm is more. You can see it's more than your value of the levered firm using 50% debt only. So in a case 2 situation, the best thing to do is to take on 100% debt. Okay, I think we are slightly out of time, and we kind of already exceeded. I know that it's a little late as well, so I'm just going to stop here. Want to find out if you do have any questions. Okay, those that need to leave, you can leave. Because we are done for today's lecture. But if you do have any questions, if you want, you can unmute yourself or put them in a group chat. Or you do have any queries regarding the lecture today in general? Okay, maybe a little too heavy at the end. So you know what? So yeah, it's a bit tough. I understand. Yeah. Okay. Yeah, I know it's a bit tough. Especially usually the last part on the theory is quite technical and kind of like you really need to review it again, and then if you do have any questions, yeah, you can just email me. So in the interest of time, I'm just going to end the lesson here. I will get back to you on the class test. I know that there are quite a lot of concerns. Hear your concerns, so I'm just going to reach out to the course coordinator and the team to see what's their stand, whether I can go through the questions or not, or what are some comments, right? Because I understand there's some quite a bit of concerns there. And I'll update you all on the next lesson. And yeah, so let me just stop the recording.